Thanks, Chris. And actually, a question from our good friend Chris Walker at FSB. What's the main barrier to funding MSMEs? Is it the cost of compliance or the underlying banking cost, being large institutions and the associated overheads? And actually, I think that ties in nicely with our next section, where we'll cover regulation, policy and trade reform. And Chris, I'm going to ask the next question to you, and going back to your earlier points. So multilaterals such as the WTO, ICC, UNCITRAL have undergone a number of initiatives to reform trade. But I think there's a disconnect. What do you think? What's going on? Is there a disconnect between what's going on in Brussels and Washington and on the ground?
Well, I think it's different things. At multilateral level, there is a lot of effort going into modernize rules, introduce new interoperable digital standards, and engage and promote participation on the ground in terms of adopting and transforming industry processes and systems. You know, those are all the right things to do, but as with all things at multilateral level, that's all about creating the enabling framework for companies to grow, and that takes time. The good news is that the initiatives are underway, and in large chunks of the world working very closely together. There's a lot of goodwill, political will, to see solutions. So I think that's an important point to make. There is a separate issue around the disconnect between particularly the US and China and the EU around the digital economy. And that's what I call sort of the new Berlin Wall that's coming in, where increasingly countries, companies, industries are having to choose who they are working with, what networks they're on. And the short answer to that is nobody will win from that scenario. What we don't want is a divided world. You know, it won't work in a context of global value chains where you're working across multiple jurisdictions. We really do need those big trading blocks to get around the table in a mature fashion and figure out what the solution is, so that we don't get into a situation where we're all divided along political lines, which will absolutely come at a cost to industry. Just to put a number on that, there's going to be some interesting numbers coming out of The Economist in the next couple of weeks. But the current estimation is that the trade war between the US and China alone is costing the global economy 21 trillion. And that's today. It's a huge amount of money, and it's impacting all of us. You know, that number will grow the longer this goes on. So I think at regional level, we need solutions, particularly between the US and China. At multilateral level, we need to get behind and support initiatives. And then at national level, we need to be working with our governments to make sure that our national governments are modernizing and upgrading systems so that they're fit for purpose for this new modern digital trade environment.
Thanks, Chris. 21 trillion, massive number. And I remember just 2 years ago when we were at ICC Beijing and how things have changed so quickly since then. A question from Ananth, and this is directed at George and probably moves on to our next question. Are there guarantees and credit mitigation support or backstop financing facilities available from African central banks or various export agencies? And also, George, going back to Chris's previous points, what's your take on this?
Yeah, so there certainly are backstop guarantees, and throughout COVID and throughout 2019, we really saw a significant level of support from the DFIs. In particular, the rest of the international investor community, banks, etc., disappeared along with when the economic consequences of the pandemic lockdowns became apparent. But the DFIs were there, and they had a number of products on their shelf, which they were able to quite quickly deploy. And in Absa, we made great use of those to support trade finance across the continent in the very dark days of April, May, June this year. A big part of that was liquidity, but an equally big part of that was some of the credit support that we received in the form of guarantees. I guess this really falls into two separate buckets. One is around the regulation side of things, which I'll talk to in a second. But around this particular piece, which is really policy, there are products which have been provided by multilaterals and DFIs and designed ostensibly to support trade. The problem is that it tends to not really be effective because of some of the requirements that the DFIs have when you want to use those guarantee products and even the liquidity products in support of trade finance. So in order to prove that the money is being used in a proper fashion and is not being squandered, there are huge evidential requirements that are levied by the DFIs and all parties who are contributing to this cause. They all want significant and really impossible levels of evidence that those dollars are being used for trade finance in Africa and developmental support of trade finance in Africa. The problem is that real SME or MSME trade finance just doesn't fit that evidential requirement. We're talking about hundreds of thousands of MSMEs and potentially thousands of individual trade assets, all of which we need to somehow curate those huge portfolios and information around the buyer and the seller, and whether the merchant is a woman, female-owned business, where the goods are coming from. All of this information is perfectly reasonable on very, very large non-MSME DFI support of trade. But when you're dealing with real MSME trade finance, it's just not practical. There's a huge data problem, and the DFIs just simply don't trust the commercial banks to use the money in the way that it's supposed to be used. And if they do trust them, then maybe they do trust them, but their boards in Washington and London and Frankfurt, etc., all require the evidence and the proof that the money is being used in the right way. So that's a big policy thing that we need to overcome. There's also very sensible ESG requirements, environmental social governance requirements, that come along with that type of guarantee program and that type of lending, which is very, very sensible in the developed world. The harsh reality in Africa is that the whole place runs on diesel, and some of the credentials, some of the social responsibility credentials, need to be appropriate for particularly MSME trade finance. So really there are these two issues from a policy perspective. I guess the other point is that the DFIs typically want and the multilateral agencies typically are using debt products as the template for trade finance. And they really can only lend 2- and 3-year dollars. And that's just simply not appropriate for a 60-day trade transaction for a small merchant or farmer in an African country. So we need to solve for all of these issues, and the developmental support needs to be in the right shape. I guess, from a regulatory perspective, it is, as Chris was talking about, there are issues with Basel, in particular Basel II and Basel III, and largely emerging market African trade finance is an unintended casualty. The collateral damage, that regulation is aimed at global and American investment banks, and after the 2008 financial crisis, it's not appropriate for African transactional banks and emerging market support of trade finance, and that's another piece that needs to be solved in one way or another, it's clearly from all of the empirical data out of the ICC, it's not only damaging the trade finance in emerging markets, it's also not appropriate, right? So the information out of the ICC trade register through the financial crisis, through the financial cycle, all demonstrates that even emerging market trade finance, is very low default, and the capital burdens and the liquidity burdens that have been placed on trade in Africa through this global regulation, it is not needed, and the hope is that some of this regulation and some of the policy issues that I've spoken about, might be walked back.
Thanks very much, George. And I guess, Nana, we'll go into a little bit more detail on the low risk nature of trade finance assets, which, as George mentioned, is very well documented. Just a reminder to the audience, please feel free to continue the conversation on the extremely active chat right now and the Q&A. It seems like there are lots of different really engaging conversations going on. So, Nana, given the low risk nature of trade finance assets are very well documented, MSMEs, particularly in some emerging and developing markets ADB operates in, are problematic. What can DFIs do to accelerate and promote better trade policy that enable trade finance access to MSMEs?
Thank you, Deepesh. So there are a number of initiatives we think we can promote in order to help SMEs access trade finance going forward. We think it's important to promote global adoption of the legal entity identifier, first of all, so that everyone agrees on a common method to easily identify the players involved in trade finance. So global trade benefit in a big way from having a single trusted global entity that could verify the identity of companies that banks finance, showing who is who owns whom and what. The LEI is a 20-digit alphanumeric code developed by the International Organization for Standardization. The Global LEI Index provides open, standardized, and high-quality legal entity reference data. Countries without an ID system don't even need to create one, and governments can simply encourage or require through legislation companies to acquire LEIs. Countries that do currently have ID systems should consider mapping these to LEIs for global harmonization. So this is one of the initiatives that we think could help global trade finance. We are also supporting the idea of adopting model law on electronic transferable records by United Nations Commission, which aims to enable the legal use of electronic transferable records both domestically and across borders. The model law applies to electronic transferable records that are functionally equivalent to transferable documents. These are typically bills of ladings, bill of exchanges, promissory notes, and warehouse receipts. Electronic transferable records are a fundamental component of a paperless trade environment, which can make an important contribution to trade facilitation and potentially could reduce cost for SMEs. And going forward, of course, we think that close coordination will be key. We think that entire trade and supply chain ecosystem needs to shift to digital processing in general. And with this, economic recovery can be quicker and stronger, we believe.
Thanks very much, Nana. And I guess that also answers a question from Bersu Tunsa on the importance of LEIs and also MLETR.
Yes.
Claire, how can public-private partnerships help accelerate this? And let's perhaps talk about the recently announced Adb Mastercard Partnership that you announced last month.
Sure, thanks, Deepesh. Yeah, we're delighted to have the support of ADB in this specific partnership, which is in retail trade, actually. But we also have a number of other partners. So within this is Finastra, SG Biz, and M-Funds. And each of those groups brings something critical to be able to support obviously the whole ecosystem. And I want to go back to the earlier points that I was raising around it's finding enablers through digital, right? So some of these companies clearly have data today, which is tracking the flow of goods between FMCGs, wholesalers, and ultimately retailers. And that information is absolutely really valuable. And the secret source to be able to give that MSME a digital history of their trading transactions, which is clearly what's been missing. In addition to that, we're then enabling the digitization of payments for the MSMEs. So that gives them the performance history around the payments. So the FMCGs, we're working with a number of them. They are very, very keen to move very quickly, given what's going on with COVID-19. We're doing this with our partners and ADB, starting in Indonesia, and early next year looking to roll this out across AP, then moving into Vietnam and Philippines. So it really just underpins overcoming these problems around having the transparency, going back to George's point earlier, around just not having the transparency of data to be able to facilitate the comfort around financing this particular segment. So that's what we're doing. We've also done something similar with Unilever in Africa, using exactly the same principles and today I think we've got around 20,000 retailers benefiting from that scheme, and we're moving that into Egypt. So we're very excited about what's to come.